Hello, guys and girls. I welcome you all again to a new section of the Forex Beginners course. And in this section, we are going to be talking about what spread is. Let's get into it. In Forex, spread is simply the difference between the bid price and ask price. In the previous section, I already explained what bid price is and what ask price is. Bid price is the price that the buyers are willing to buy from you, and the ask price is the price that the sellers are willing to sell to you. So, and I already explained with a practical example also and how it works in the forex markets. When you place a buy order, it is going to be activated for you using the ask price. And when you place a sell order, because you are the seller now, it's going to be activated for you using the bid price. So I hope you get the concept. So spread is simply the difference between the bid price and the ask price. As I've said earlier, ask price is usually higher than the bid price. So let me show you an example here. You can see here the bid on in GBP USD, the bid price is 1.3089 and the ask price is 1.3091. So if we are going to get the spread will be 1.3091, which is the ask price, minus 1.3089, which is the bid price. So we have 2 pips. It means the spread is 2 pips for GBP USD here. So you can see in the pip, they used the fourth decimal place digit in the bid price and the fourth decimal place digit in the ask price for calculation. You can see that is how it works as I've explained earlier. So to get the spread now, you are just going to subtract the ask price from the bid price. That is how you get the spread. I'm going to explain what base currency and quote currency means later. So here AUD NZD, you can see 1.0679 and 1.0689. If you have been following me, I'm sure you are going to know what the ask price is here and what the bid price is. Here, the ask price is 1.0681 and the bid price is 1.0679. So the spread is simply the difference between the ask price and the bid price. But in the forex market, it is a little bit complicated than that. So the spread usually determined by your broker. They are the one that determines what spread they are going to give you, and it usually differs from broker to broker, but the difference are not usually very much. And it also depends on the session you are trading. For example, if you are trading when just one session is open, I tell you there are a lot of sessions in the forex market. We have the Sydney session, London session, Tokyo session, Asia session, etc. So if you are trading when just one session is opened, the volatility will be low and there's a higher chance that spread will be high. And if you are trading when maybe 2 or 3 sessions are open at the same time, then you have a higher chance that the spread will be a bit low because volatility will be high at that time. So that is how it works. So this is GBP NZD2. So you can see the spread is a bit high for GBP NZD. It also determines the amount of people that are trading that particular pair. For pairs such as the USD pairs, GBP USD, EUR USD, USD CAD, USD CHF, a lot of people trade USD pairs. So the spread is usually low because there are a lot of people trading it already, and your broker don't need to give you a high spread. But for pairs that people don't trade a lot, such as GBP NZD, AUD NZD, and some other pairs, the spread is usually a bit high. So don't be surprised if you see some pairs that have a significant high pair than some other pairs. But you don't have to worry about that. The difference is not usually very much. So base and quote currency, like I've said before, the first listed currency of a currency pair is called the base currency, and the second currency is called the quote currency. The base currency is usually stronger than the quote currency, except on some rare occasions. Like the image I showed you earlier, this is GBP USD. So here, GBP is the first listed currency, so it is the base currency, while USD while US GBP is the first listed currency here, so it is the base, while USD is the second listed, so it is the quote currency. So here you can see that GBP USD, it is usually GBP USD came first because it is stronger than USD pair. So most often, more often than not, the base currency is usually stronger than the quote currency, except on some occasions, which I'm going to be showing you later. So if you see a pair like AUD card, so from there you can know that AUD is the base currency and card is the quote currency because AUD came first and card came later. Let's continue. So to refresh your memory, the first listed currency of a currency pair is called the base currency, while the second one is called the quote currency. And usually, the base currency is usually stronger than the quote currency, except on some occasions. So these are some of the examples. EUR here. EUR is the base currency, while USD is the quote currency. And you can see that EUR is stronger than USD. But let me show for USD JPY here also. USD JPY. USD is the base currency, while JPY here is the quote currency. But you see, for some pairs like USD CHF, NZD USD, and AUD USD, the quote currency there, they are stronger than the base currency. That is why they start with 0.0.0. That is why they are not up to 1, because the quote currency there, they are stronger than the base currency. You can see here USD is the base currency while CHF is the quote currency, but the price there is 0.9320 and 0.9320 here. Why is that? Why isn't it up to 1? It is because CHF is stronger than USD. So CHF is the quote while USD is the base currency. Here also NZD USD. NZD is the base currency here while USD is the quote currency. So but it's not up to 1 here also. Why is because NZD is not as strong as USD. So that is why they are like that. I hope you are getting it. Now, analysis. We are getting to the interesting part of this course, analysis. There are two major types of analysis in the Forex market. The first one is fundamental analysis, while the second one is technical analysis. Don't be surprised. Some people might tell you that there are more than three types of analysis. There are more than two types of analysis in the Forex market. Well, you don't have to argue with them. They can have as much as they want, but there are two major types that traders talk about and traders use in the forex market. And the first one is fundamental analysis. The second one is technical analysis. And this analysis is what we use to form our bias in the market. There are it is this analysis that we use to know the direction that the market is most likely going to end up at. So fundamental analysis. What is fundamental analysis? Fundamental analysis is a way of looking at the forex market by analyzing economic, social, and political forces that may affect currency prices. It's mostly traded using news events. So this is fundamental analysis for you. Most people, they don't use fundamental analysis alone. So because it is you have to know there's a certain time that news are released for each of the currency pairs. USD, for example, there can be major news like NFP that I've explained before. There's CPI news too. So there are some major news that push the market a lot, that brings a lot of momentum into the market. So some people use that to trade. So that is why there's something called fundamental analysis, because it's a way of looking at the forex market by analyzing the economic, social, and political forces. So each data that they release during the news is what people use to determine whether they're going to buy or sell a particular pair. And it is mostly traded using news event, like I have said before. Let's go to the next one, which is technical analysis. Technical analysis is using past price action and patterns to predict future price movements. you have to take candlestick formation and price pattern into consideration. Now, let me tell you this. As a Forex trader, you are going to be using technical analysis the most. Again, you are going to be using technical analysis the most. It is what most Forex traders use to determine future price movements. And how do you do technical analysis? It is the use of past price action. What has price done in the past, and what is it doing now? Is there similarity? So if there's a similarity, you look at what happened when it happened in the past, what happened after then you use it to determine, oh, since it happened before and this happened, then it is happening now, then a similar thing is also almost going to happen. So that is how technical analysis is. And I'm going to be teaching you how we are going to do technical analysis in this course. So stick with me. But before we talk about technical analysis in details, let's discuss the types of candlestick. Because before you know technical analysis, you need to understand what it comprises of: candlestick, price pattern, etc. So candlesticks. The first one here, which is green, is a bullish candlestick. What is a bullish candlestick? You see, when a particular market opens, it means a bullish candlestick is a type of candlestick that closes higher than its opening place. When this market opened, it's opened here at the bottom here, and when it's closed here. Can you see where the cursor is? So that is a bullish candlestick. And bullish, I already told you that bullish means a market is trending upward. So this type of candlesticks, it happens when you see them mostly in a bullish market, a market that is trending upward. So this low is the lowest point that the market got to before it reversed, and this high is the highest point the market price got to before it closed at the current place. Now let's go to the bearish candlestick. Bearish candlestick is just the opposite of bullish candlestick. Bearish candlestick, it will open higher and close lower. This place is where the candlestick opened, and when it's closed here. So that is bearish candlestick, and you will mostly see this candlestick in a market that is trending downward. Bear, when you're talking about a bearish market, we are talking about a market that is trending downwards. So that is where you will most likely be seeing a lot of bearish candlesticks. So it opened at the top here and closed at a lower place. So this high here is where the highest place the candlestick got to before it reversed, and this low here is the lowest place it got to before it's closed here. So as we dive deeper, we are going to be understanding a lot of the candlestick. Maybe I should show you on a live chart so you understand what I'm saying clearly. Let us use EUR/USD as an example. You can see this is 1 hour time frame. Yes, this is 1 hour time frame, and you can see a lot of green and red candles. So if we look at this current candle, you can see it is a bearish candle. It means it's opened at this place. Let me mark it so you can see. This is where it's opened, and this is the highest place it got to, and it is currently here. It has not closed. But if we look at a bullish candlestick, let's look at this one. This is a bullish candlestick. It means the candlestick opened here, and it's closed here at a higher place. And this is the highest place it got to, and this is the lowest place it got to. So that is candlestick for you. Let's go back. So I hope you understand the concept of candlestick now. The bullish candlestick, it means it closed lower than where it opened. And when we are talking about a bearish candlestick, it means it's closed, no, sorry. When we're talking about a bullish candlestick, it means it's closed higher than where it's opened. And we are talking about a bearish candlestick. It means it's closed lower than where it's opened. It means a bearish candlestick, it is coming downward, it's closed downward, and a bullish candlestick, it's closed upward. So that is candlestick formation. So there are various types of candlesticks, and we are going to be getting into them now. We have the high test candle, we have the low test candle, we have the doji candle, we have tweezer tops, we have tweezer bottoms, we have bullish engulfing, we have bearish engulfing, we have 1 hour retrace, we have hanging man, and we have morning star. So let's get into each and every one of them. So before I continue, I want you to know that it's not about the name of the candlestick, but it is about the psychology and area of formation. For example, the candlestick I showed you, like this bullish candlestick and the bearish candlestick, sometimes you are not going to be taking actions just because they appeared anywhere on the chart. You are going to be taking action because of a particular area where they appear. So that is what we call the psychology behind the candlestick formation. You have to wait for them to appear at a particular area before you take your decision. I'm going to be explaining where and why and how you are going to be taking those decisions in this course. So this is the high test candle. This is how it looks like. And let me tell you the psychology behind it. A high test candle is a rejection of the structural resistance level. And the psychology behind the candle itself is that traders are testing a certain level during the initial stage of the candle formation. And by the close, it has retraced significantly back to where it began. You can see this, the candlestick, sorry about that, the candlestick, this is where it opened. And you can see the high here. This is the highest point it got to before it reversed significantly back to this place where, and it opened here. So that is the candlestick. It opened at the bottom here and then went upward to this high and then retraced significantly close to where it opened, and this is where it's closed. That is high test candle. It means the candlestick, it's traders are testing a certain level during the initial stage of the candlestick formation. Low test. Low test is just like the opposite of the high test candle. So it is rejecting a structural support area and signaling a move to the upside. Combined with patterns such as descending channel, which I'll be explaining later, and double bottom, a low test candle increases in significance. So you can see the low test candle is like the opposite of the high test candle. It's opened here and then came to this low and then retraced significantly and closed here close to where it's opened. So the psychology behind this candlestick is that buyers are testing a certain bottom, or they are testing a significant um, structural support area. So it means there are bulls, which are the buyers. They are about to enter the market and they are pushing the market upward. So let's go to the next one, which is doji. Doji is a low momentum candle that closes where it opens, and it hasn't really pushed far in either direction, whether up or down. We see doji candles primarily where there's slow down in price. So generally, during the correction in an impulse move, as it approaches a structural support level, or in the corrective phase continuously as price trickles its way sideways. You see this doji candle, it is, you can say that it has not moved neither up, it has moved upward, it has also moved downward, but then it has also closed very close to where it opened. So there's no significant movement, and it usually happens when price is maybe about to turn around or when there's low momentum in the market. Let's go to the next one, tweezer tops. So tweezer tops is just like is the form is it consists of two high test candle. You know, we've already explained the high test candle before. So tweezer top is just like the formation of two high test candle. So it represents a double rejection of the area where they appear. Double, we already said that top is like rejection of a certain area. So when you see double it, it's like a double rejection of that particular area. So price has tested an area throughout the course of two full formation and closed back down close to the open of the candle. So it is more powerful than a single high test candle, and it's often a sign that price is ready to head lower. In high test, it is just one, but since choosing top is just two of it, it means it has a stronger confluence that, oh, I think sellers are stepping in and price is about to reverse. Choosing bottom is also like two of uh, low test. Yeah, chooser bottom is also like two of low test. It has rejected a particular area at the lower place twice. So it is stronger than just one low test candle, and it signifies that price is likely to reverse upward because price has come downwards here and then reversed. It also came back the second time and then reversed. So that is the psychology behind tweezer bottom. Now, this is bullish engulfing. A bullish engulfing candle is momentum in the upward direction. We utilize bullish engulfing candle to analyze when price is moving impulsively or correctively. Candlesticks are not the only thing we utilize to determine what phase the market is in, but they are key components. Like I said, you need to know the area where the candle is forming. So a bullish engulfing candle is a momentum candle upward. You can see that it is very, very heavy. So it's opened here and it went up very, very well with heavy momentum and closed here. So that is bullish engulfing for you. Now, bearish engulfing. So this is the opposite of bullish engulfing. Just like I've said before also, the area where they appear will determine a lot. So it will determine whether sellers are stepping into the market because the market, it's open at the top here and then reversed heavily downwards and then closed here. That is bearish engulfing for you. 1 hour retrace. The 1 hour retrace candle is a very powerful candlestick formation. It essentially is the rejection of an outline area. By fully retracing the previous candle and closing above or below where the first candle opened, depending on whether it's a buy or sell. So you can see here, this is a bullish engulfing candle, and beside it is a bearish engulfing candle. So a 1 hour retrace, let's say this is it's appear on 1 hour time frame. It means this bearish engulfing, it has fully closed back down the previous candle. Sometimes when you see a bullish engulfing like this, you might see a doji candle, which means a low momentum candle between them. Then you see a full 1 hour retrace. It means that there is likely going to be a turnaround in the market. Reverse can also be the case. Let's say the bearish engulfing candle is at this side and the bullish is at this side. Then it means that the bulls are likely stepping into the market. Since they have pushed the market from where the bearish candle closed, they have pushed it back upward. So that is the 1 hour retrace. It can also appear on different time frame. If it is on 4 hour time frame on the chart, then you call it 4 hour retrace. If it is on daily time frame, then you call it daily retrace. If it is on weekly time frame, then you call it weekly retrace. So that is it. You are going to be understanding a lot of them as we go on. Hanging man, very much like low test candle. However, it is going to be found in different area. It's normally at the end of an exhausted run. The market is losing momentum and it is treated as a reversal type candle. It has a long lower wick. However, this candle is found at the top of a run rather than rejecting the bottom of the structure area. Same physical appearance. However, the difference is the area that you find it. You can see it looks like a low test candle, but you are going to be finding them in different areas. Like I've said before, the area is what matters most. You don't just make decision because you see a candlestick anyway. You are going to be making decision based on where the candlesticks appear. Now, morning star. Same morning star, same as evening star. The morning star is not very common candlestick formation. Price impulses to the downside. The doji candle represents a slow momentum, like I've said before, and the impulse in the other direction confirms the reversal formation. So it's resemble the sun setting and sun rising. Look at this bearish engulfing. The market opened there and then closed there. Then there is a doji candle in between them, which signifies a low momentum. It means that the bears, which means the sellers, maybe they are exhausted, and then it signifies an exhausted one. The doji candle also signifies that, oh, there is likely going to be a turnaround, and then the bullish engulfing candle retraces the doji candle and goes up. So it's like a sun setting and then a sun rising again. So that is the morning star for you. Then the evening star is just the opposite of the morning star. The difference is, though, when you see a clear evening star, especially on the higher time frame, it can be a very good indication that heavy momentum is about to kick in. When you look at the evening star, it is bullish engulfing followed by a doji and then bearish engulfing that is similar to the size of the first bearish engulfing candle. So you can see here that from the evening star, there is a bullish engulfing candle, and then there's a doji candle in between. Then there's another uh, bearish engulfing candle that significantly retraces the previous two candles. So that is evening star for you. So, and this type of candlestick formation, when you see it as at a significant area, it signifies that, oh, there's likely going to be a heavy turnaround in the market. So I think we are going to stop here for this section. And in the next section, we are going to be discussing types of price pattern that we have. So thank you, and make sure you go on the charts and look for these candlestick types that I've mentioned and mark them out so that you are going to be significant with them. You are going to be familiar with them. So thank you.